taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to the week that was. Just the two of us today, Stephen.
Hey.
Terrible twos.
Pilot and co-pilot.
Yes. Tom's in Cairns getting away from the
We
cold.
had to sack Tom, cost cutting.
He's expensive, hey. We can go to the Bahamas now. No, welcome everyone. Tom's in Cairns today.
He is.
He's getting away from the cold down here.
Yep.
So
Good job if you can get it. Anyway, you've got us.
You got us. Well, the boring guys, and we're reviewing 15 to 19 of July.
Yep.
That week was a big one, right? Donald Trump shaved his ear off.
Donald Trump nearly got killed, assassinated.
And then Biden assassinated himself.
Then Biden assassinated himself. Yep. And there was about 8 million conspiracy theories on both.
Yeah.
Donald Trump was tried to be murdered by the FBI, the CIA.
Yeah.
It was his own crew.
And we only speculated on 7 million of those.
Yes.
Yeah.
Yes.
Well, I saw one where he's what are they called? The Secret Service team. It's not Secret Service if you're not the president, right? Or do you still get access?
What if you're an ex-president?
Yeah.
Ex-presidents get all Secret Service, full security.
Yeah, right.
Absolutely.
That was a conspiracy that the Secret Service jumped him and then sliced his ear off.
You gotta love America.
Jesus, they're on it. Anyway, Magnificent Seven's super overvaluated as per, and that's actually an interesting one because I think you mentioned in the recent week that was that we might see something similar to, which we can talk about in the next week's podcast in more detail, but we might see something similar to the tech bubble where
2000
economy, like the general stocks, the Russell 2000 and things like that, they might stay relatively okay.
Yes,
but the tech side of things takes a bit of a dive.
A dive. The same as, what you're saying is right. In 2000, what happened was the stock market, particularly the NASDAQ declined 80%, 87% or something, right? But it bifurcated or diverged from the small caps, and that was because in the bubble of 2000, 95 to 2000, it was those big tech stocks that went absolutely gangbusters. And what you've got to remember is if you've got $100 and you want to invest, generally you will go with the market cap, right, weighting. If the big stocks are growing really quickly, that's where more of your money goes. And so what happens is you get this positive momentum where it just keeps feeding itself, right? And in 2000, when the market crashed, it went down 11, 20 and 20 over the next 3 years, but the economy didn't. And the reason why was because generally a lot of the wealthy people were invested in the IT stocks. So in other words, it wasn't the general, Billy working at Walmart saying, "Oh, I've got Nvidia stocks and I'm making a fortune." It was actually just the top 10%. And so when the market fell, it didn't damage the economy that much because it was like wealthy people saying, "Oh, I haven't got 2 billion, now I've got 1.6 billion."
Yeah.
Right? So it wasn't a direct hit to the economy of I can't buy any more baked beans because, all my Nvidia stocks lost money.
It's like fabricated.
Fabricated well,
numbers.
it's just what you have to look at when you look at the stocks and a whole raft of things is you have to look at the distribution. How are things distributed? And that's why the average is no good, right? Because the average is a compilation of all individuals. And what you've got to ask yourself is, and it's the old one of, there's 10 men in a room and they're all billionaires, right? And 9 of them are poor and one's Bill Gates. Well, on average, they've all got billions, right? Yeah. And that's the point. The point is you have to look at it and say, well, hang on, how is it distributed? And what you see is in the US market, stocks are predominantly owned by the wealthy. Because the poor people can't afford to buy stocks, right?
And they don't know how to.
Well, yeah, and they're just working a job and, trying to earn a living.
Yeah.
So they don't have excess income. And so when you look at, if you say, the stock market might fall 30 or 40%, what you have to say is, okay, who gets impacted? If it's the wealthy, then they will probably not adjust any of their spending anyway. Like, it doesn't matter, right? So that's the really important point, because the economy really rests on demand, and the demand comes from people spending money.
Yeah.
If you are, a wage earner and you earn, $1,500 a week, right? You're going to spend all of that, and you might save a little bit. But what wealthy people do is they actually take a surplus out of the economy, right? They started the year with 5 million, now they got 5.5.
Yeah.
That 0.5 has to come from somebody else who went down 0.5.
Yeah. Or thousands of people.
Yes. Yeah. But the main point there is you've got to look at how things are distributed, and that's why in talking about property, it's you can't just use blanket statements, because you've got to say, well, hang on, 30% own their property. Well, they don't care if it goes down, right? They're not going to go, oh my God, we're in trouble. It's the marginal ones, right? The 30% who have got a mortgage. And of that, it might be 30% who are saying, we can't afford another rate hike.
Yeah.
So that's where you've got to look at the distributions, and it's really, really important, because it helps you get to understand what the potential outcomes are going to be.
Yeah, I think it's interesting. And what sparked my interest in the week it's just gone, or the video that was just released, is the difference between the 2001 tech bubble bust and the GFC crash.
Yes.
The GFC was much more terrible.
Yes.
Because it just affected many, many more people residentially and things like that.
Yep.
Whereas the tech bubble was almost a fabrication of, Microsoft's lost 70% of its value, but everyone will still go to work tomorrow.
Yeah. Well, the GFC was also a housing issue. You see, and this is a bit of if you look at the last 30 to 40 years of the changes that we had in the global economy post-1980, what you get is an enormous amount of speculation, right? So before 1980, nobody talked about property as a negatively geared asset. There was no bloody 45-year-olds telling you're going to get rich buying property, right? Because it just wasn't the way society operated. But now that you've got a lot of free money, you've got private capital, you got Bitcoin, you got all these things you can invest in. What you're getting is you've got speculative bubbles, and it basically comes from finance, right? Yeah. And so what happened was with the mortgages, what people don't realise is those mortgage-backed securities, right, was an idea from a financial guy in the US, where he said, if we bundle all of them up and we sell them and they generate 3 or 4%, we will get places to buy them. And the people who bought them were largely foreign governments. Now, that's a story for another episode. But my point being, what they were doing was they were financializing these assets, and they were then becoming not people's homes, they were becoming financial products.
Right, okay.
Right? And it really impacted. So if you look at the 80s, we had the savings and loans scandal in the US, right, in the late 80s. Then we had the emerging markets crisis in the late 90s, right? Then we had the tech bubble blow up in 2000. Then we had the GFC in 2007. So what you're getting is every 10 to 15 years, you're getting this massive reset because of all this money sloshing around the world, right? And at the moment, there's a lot of it sloshing around in the US market and in property markets. And it's all got the same cause, which I'll talk about, as I said, in another episode. But what it's doing is it's magnifying everything. So you get this momentum on the upside, but you get it on the downside.
It's a massive crash on the downside.
Yeah. And it's swift, right? But this time I think it might be slow. And the reason why I'm saying that is because it's so big. right, that governments are going to have to, again, like the GFC, step in and say, listen, we can't let this thing go to hell in a handbasket. There'll be 20% unemployment.
Yeah.
You know, that's why I say it's only government that can solve that.
Well, you compare them to recessions back in the day, I'm thinking 1920s, and they were long, grinding, because money was slower then.
Well, yeah, and the belief back then was that you couldn't interfere with the market, right? You had to let the free market operate. And it was only in about 32, and I can't remember the president, but Hoover, I think it was, who said, this is bullshit, we need to step in here and do stuff. And that was the New Deal, right? And the New Deal was the government's going to spend lots of money, and that's the only thing that saved them. The next time that saved them was basically military spending. Right, that's the way, you know, governments have always got to these days having a legitimate excuse to spend money. So in Brisbane, it's the Olympics.
Yep.
Right. Oh well, come on, dude, we've got the Olympics. You've got to allow us to spend some money, right? And that's what they do. And warfare is another national security is another great reason to say, hey, mate, we got to build these things for national security.
Yeah.
Not many people are going to argue that you shouldn't protect the country.
Yeah.
Right,
yeah.
And if you do, well, you're obviously not a real Australian because we got to protect our borders, right? And that's what's going on.
Yeah. All right. Well, Tom's not here to keep us on track, and we ended up talking about recessions.
Yes.
So, what else is in here? We've got Australia's budget surplus could be larger than initial forecasts.
Yes.
Which is not really a surprise. And Jim Chalmers on Monday said that the Labor government looks to set to record its second straight surplus helped by strong employment and high commodity prices.
Yeah.
Again, we've been talking about for weeks anyway.
Yeah. It's just, look, as I said, it's just seeing how the closer we get to September, November, August, September, October, November, the more we want to track the spending or the not spending of the tax cuts.
Yeah.
Right? If people don't spend it, which I don't think they're going to, then you're not going to see a bump for economic growth, and you can't really expect a strong economy out of that.
I've been, funnily enough, keeping a tally chart at work in my book, asking everyone what they're doing with their tax, and I think 9 out of 10 people so far have said they're paying that down there.
Yeah. Well, look, if you've got mortgage stress, the last thing you're going to do is get $100 and blow it, right? The first thing you can do is pay down your debt.
Yeah.
That's the first thing you're going to do.
Which is not good for growth, right?
That's right. Well, if you just give it to the Commonwealth Bank as debt repayment, and this is the point I'm saying about debt. Debt steals from future income. At some point, you've got so much debt that your future income is completely allocated and you can't borrow anymore. And that's when property prices and the economy starts to fall, right? Because there's no more demand, right? Because people are not spending money. They're paying down the big debt. When interest rates rise, your debt goes from $1,000 a month to $2,000. There's $1,000 that you're not spending on avocados and coffee and going to the pictures and all that sort of stuff. So that draws it out of the economy.
Yeah.
Right. That's why debt becomes a problem if it's not productive.
Yeah. And look, there's these rate cut questions that are spiraling around saying, oh, we're having rate cuts in 25, might be 26, it might be 27 now. And you're thinking, well, we're going to be buggered if it gets pushed out anymore.
That's the problem we got. Right?
And that would definitely be a recession then.
Well, the problem Australia's got is the debt level is too high.
Yeah.
Right? This is what I've been trying to say to people. And, we get comments on Instagram about property prices and, you're full of shit and you don't know what you're talking about. Look, all I can say is this. At some point it rolls over. If you don't think it rolls over, by all means, go to the bank and borrow $5 million, because if you think it's not going to roll over, well, there's nothing stopping you from making more money, right? But that's not the way markets work. And it's always around the top where you get people that are most vociferous about, you're full of shit, it's never going to go down. It's like, oh, right, okay. Mm. And I can name you half a dozen people off the top of my head who I know have lost money in property.
Yeah.
Right? And it's the same with stocks. Oh, Nvidia's not going to go down. Don't be full of shit. It's going to carry on for 10 years. It's like, well, okay, best of luck. That's what history doesn't show.
Yeah.
And even when people say, based on fundamentals, if you look at it on fundamentals, ratios, property PEs are at about 45.
Yeah.
Right?
Well, there's a paper that you sent through.
Yes.
Basically saying that we're about 30 to 40% overvalued on property.
Absolutely.
And if you want numbers and stats, we can post them up there. But it's very telling argument towards why property is super overvalued. We're not just picking on property either. If anyone that says anyone that walks in the room and says, "Oh, let's just put all your money in the S&P 500," we're saying, "Whoa, fella,
exactly,
just calm down."
Yeah,
we are stocks, right? It's what we do. So it's about market cycles. It's about just taking a step back, taking a breath, and going, okay, before you get leveraged up to the knees in property, just have a look at how overvalued it is first and make an educated decision. If you still want to go ahead, amazing.
Yeah, it always comes back to valuation, and it's what we're saying about the Magnificent Seven. If you want to buy Nvidia on a PE of 80, by all means, go ahead. Don't let me stop you. But I'm just telling you, buddy, that the way markets work is you may not make money over the long term. Next 6 months, absolutely. I mean, year to date, Nvidia's gone up, what did we say, 200% or something,
It
right?
changes every day, but yeah.
You look at that and go, oh, well, in 6 months I could double. Okay, you could, but you could also lose 50% of your money, right?
Yep.
And this is why we were talking about the tech bubble, right? At the top of the tech bubble, and the bubbles before that, the Nifty 50 bubble, right, the housing bubble prior to the GFC, everybody was just simply extrapolating out the recent stuff, right? And the difficulty, Jacob, with bubbles is you can't see the pin, right? So what's happening is you just think it will go on forever. And the longer it goes on, the longer people think it will go on. But perversely, it's actually the shorter time you have left, right? This is where people get caught. Retail investors go into investing late in the cycle because they then think it's safe.
Yeah.
And what they don't say is, hang on, that property you bought at a PE of 10 is now on a PE of 40. It's not the same situation.
Well, retail, it's like a classic bell curve. Retail investors get in when everyone else is taking the risk.
When the smart money's getting out.
Yeah. Interestingly enough, on Nvidia, since the July top, it's down 20%. And you haven't heard a word about that.
Yeah.
Down 20, that's significant.
Absolutely. Well, this is why I say everybody who bought that stock at that previous rise is now down 20%.
Yeah.
Right. And so, again, every asset is owned by somebody. Right. And if you buy, and you see it all the time, recently, you're seeing more and more. I bought this, not I, but this person bought the property at $4.5 million in 2022, and they've now got it on the market for 4.2. And the reason why is because the repayment went from $8,000 a month to 12, and they're going, shit, we can't pay this.
Yeah.
What's your choices? Well, you can't go to the bank and say, listen, mate, I'm just struggling. Can you, you can, but banks will often say, sorry, buddy, you've got to sell the property.
Yeah.
Right? And it makes more sense anyway, because what you get to realise is you get a hard lesson in market cycles. Right. Yeah. And you end up going, we don't have a choice. That's why, again, people on Instagram saying, oh, Albo's going to come in and do this, or the Reserve Bank will do that. I'm sorry, they can't ring every property owner and say, listen, mate, we'll subsidise you. You can't do that.
Yeah, it's interesting that it's the people basically telling us to get stuffed either don't own a property themselves or they're property gurus.
Yeah, who've made lots of money, but they don't understand the cycles.
Oh, they're trying to sell their services. So you've got that as well.
Yeah. I'm not being harsh on people. What I'm saying is that I can tell you, I'm 61. I've seen markets cycle, right? Mm-hmm. It doesn't go on forever. Can it go on for a long time? Absolutely. But it doesn't go on forever. And the question is, who, as I said at the start, who owns the assets? How have they been distributed? And another reason why it might be a long, slow decline is because if wealthy people own an asset and it doesn't impact their day-to-day living, they just leave it there.
Yeah.
Right? If you've got 2 investment properties and you owe money on them, but it's only a small loan to valuation, or you're saying, well, it doesn't matter if they fall in value because I'm not going to change my way of living. Well, it'll just sit there. It may decline slowly in value, but it won't pop the bubble quickly, right? What pops the bubble quickly is the people who say,
I got to offload it.
I got to offload it and I got to get rid of it. And if I lose $100,000, that's, I haven't got a choice.
Yeah.
Right. And this is what the leverage cycle shows, right? There's some event catalyzes people that goes, you know what? We can no longer afford this property, right? And as the value in the street rises, everybody's property in that street rises. As the value falls,
everybody's does, yeah.
Everyone's falls down.
We've just moved house, but on the old street that we were on, 2 people have just sold now after our house has just sold at a loss because one of the couples broke up and blah blah blah, but they've sold it at a loss.
Yes.
So I think they bought it for 1.5. They're selling them for 1.4.
Yeah.
Because they just need to get out. They kind of, and it's the Joneses. I think it's everyone that has been made asset rich over the last 5 or 10 years that now can't afford their repayments that are having to offload it.
Yep. You're seeing more and more of it where it's not. Last sale was 2006. What you're seeing now was. Sold in 2022 for 1.4, on the market for 1.4 or 1.45, which means they're losing money.
Yeah.
Right. So what I'm saying is like stocks. I bought them on Monday, and I had to sell them on Friday because I figured out that the market was dropping 30%. And I had to get rid of them.
Well, like Nvidia bought it early July. Now I'm down 20%, and I'm scared.
Yep, exactly.
It's going to keep going down.
And the stock market's bullshit.
Yeah. What's go on? Let's talk about mega cap. So we're just into Monday. Mega cap 8 PE 35.8x is. And actually, from next week for listeners, we might have this on video so you can see it on the screen, mind, with an asterisk on it. You need to make sure the tech works. But talk to us about this mega cap, Steve.
Well, it's just, again, if you look at the Magnificent Seven, the PE is 35, but individually, I think NVIDIA, the NVIDIA, now, this is price to earnings forward.
Yeah.
Okay. First question. Oh, okay. Does the forward PE correlate to returns? Answer, no. Right? So what I'm saying is you look at that stat and go, I'm going to completely ignore it because there's no correlation with success. Okay? And that's the first question you always want to ask yourself is, in terms of when you see figures, what does it actually mean that I will make more money? And if I said, well, the forward PE has no correlation to your forward return, your next question is, well, why should I listen to it?
Why am I looking at it?
Yeah. Well, you shouldn't. Okay, well, that's what, I should ignore it.
Yeah.
Right? And so that's why I say, when I think NVIDIA's on a PE of 78.
Something ridiculous like that. Yeah.
So when you look at that, you have to say, okay, that return is below, is something like 1 point something percent. Well, look, it could go up 100% the next year. Absolutely. But at a PE of 80, it's really, it's more likely to go to 20 than it is to go to 140.
Yeah. So it's estimated long-term growth at 50.6% for NVIDIA.
Yeah.
Which what does...
a double every 2 years.
Puts the market cap at something like...
Well, it's already 3 trillion. That's what I mean. You get these figures where people just say, what did it grow last year? 45%. Right, I put it at 50%. Right? Well, that's not the way markets work.
Yeah.
Right? They work like that for a certain period of time, but no company, the old stuff, trees don't grow to the sky, right? But people get fooled by, it's gone up 100% this year, right? And it's like, okay, well, it's probably more likely to go down. Will it go up? It could do, but it's probably going to go down.
Yeah.
Right? That's the distribution of returns where, as I said at the start, you've got to look at that distribution and say, what's the range of returns? If you deal me an ace, what's my chances of getting a 2, a 3, a 4, a jack, a king, a queen, right? That's how you work it out. And if you look at the deck and say, well, Steve, there's 10 cards left and I'm sure 6 of them are, picture cards.
Yeah.
Okay, well, I've got a good chance of getting a 10 jack, queen, king and getting blackjack. Yeah. Okay, then I should bet more.
Yeah.
But if I said to you, look, Jacob, I deal you an ace, there's 51 cards left in the deck, and I shouldn't say that. There's 25 cards left in the deck, and none of them are picture cards. So what you do is you say, well, hang on, I can't get blackjack.
I won't bet this, yeah. Or you look at something like Nvidia and go, oh, the picture cards are already out. But
Yeah.
they're probably already out. There might be one or two left.
Yes.
So I might set this round out.
It's really painful for investors to do that, particularly if you're young and you haven't experienced a loss, right? Because you get like this cocaine brain, right? You just get this idea where you are definitely missing out,
Yeah.
right? And your eyeballs are attracted more and more to the things where you read you're missing out, right? So you're not reading about people who said, oh, man, I bought Nvidia bloody 3 weeks ago and I'm down 20%. You're ignoring that story because you've already decided that you're missing out. So you're listening to the guys who said, I bought Nvidia 6 months ago and I'm up 42%, right? That's what you do because you've already made your decision that you want to buy it. You're just looking for confirmation, right? And that's why I say investing is really tricky because nobody invests to lose money. And so you've already come to the investment table saying, I'm going to make money.
Yeah.
Right? Rather than saying, I'm going to invest money, but I'm not going to lose any. Now I'm going to be a bit conservative.
Yeah, or what's my process going to be?
Exactly.
All right, we've been pissing off property guys for the last few weeks. Now let's piss off the stock market guys and talk about buy and hold.
Yeah, well.
Does buy and hold work, Steve?
Yeah. Don't get me on that one. But it's just, look, I just look at the evidence. Right, and you have to look at your time frame, and I don't have any arguments with that. But we put out our second series on ETFs, coming out soon, looks at basically the probabilities of picking individual stocks, right, over a portfolio of years that gives you winners.
Yeah.
Right. So in our session on in Well 3 and in the risk hierarchy, what I say to people is, let's say you're 30 years of age, you've got, say, 30 years to invest money, right? And I'd say, okay, Jacob, you can't buy indexes, you've got to buy stocks, right, individual stocks. Okay, let's say you buy 10 a year, right, which is not unreasonable, right? That's 300 stocks over the next 30 years. Now, you have to say, okay, how many of those 300 stocks do I expect to be winners to outperform the market? Now, the argument is on a buy and hold, right, like 20 to 30 years, the probability is closer to zero than it is to 5%. So in other words, you've got really, really slim chance of being Warren Buffett.
Yeah. And also buy and hold, the theory is I've got 100 grand now and I'm going to buy something now and never again. Whereas most people actually dollar cost average into it over their life anyway.
Yeah. And that's why I argue, well, if you dollar cost average, it's a lazy way of doing it because, again, why would you buy something if it's really expensive? Why wouldn't you just say, well, I'll just put the cash away and I'll wait till it gets cheap? And again, we fall for this idea of, oh, yeah, but they never go down, right? And this is what we hear with stocks. Oh, Nvidia will never be cheap. Oh, property will never be cheap. Well, I'm sorry, you don't understand market cycles, right? That's not the way things work. They go bottom left to top right on a chart, but you're only in 20 years of that, 100-year chart. So you've got to look at the 20-year returns.
Yeah.
And they vary between bugger all and, 16%.
Yeah.
Well, the next question is, well, how do I get the 16%? Wait for it to be really cheap.
Yeah, that's right.
Anyway.
No, that's important, I think, because this is what we get questions we get every day of, I'm going to invest now and I won't touch it for 40 years.
Yeah.
I'm like, okay, well, what are you going to do in the meantime?
Well, the other thing is too, looking at the comments we're getting on Instagram and stuff, the thing that is a little bit annoying is everyone's talking about the latest cycle, right? And we don't teach you latest cycle. We teach you about market history and knowledge from all the cycles. So for argument's sake, as I say, people talk about property and blah, blah, blah. And I say, okay, what about the Melbourne land boom from 1890 where it lost money for 60 years?
Yeah.
Right. Nobody wants to talk about that. But I can tell you they sure as shit wanted to talk about it in 1910 because they were down 30%, right? And that's why I'm saying everybody thinks that this time is different, and a lot of young investors get caught because they haven't had other cycles.
Yeah.
Right? All they've seen is Sydney property from 2000's gone gangbusters. You guys don't know what you're talking about.
These guys are talking about things in the 1800s. What idiots.
Yes.
Yeah. You need to take the whole thing and go, okay, what do we learn from history?
Yeah. Well, it's like I say, it's like winning 2 blackjack hands and going, you guys are full of shit. This is easy, right? You just bet lots of money and you get it back. That's not the way it works, right? But when you're in, that's why I say, when you're in that frame of mind, it's really hard to say, Jacob, listen, mate, there's been other countries that have had property bubbles and they've never stopped them bursting. So how is Albo going to stop the property bubble bursting? And people say, he's going to just let immigrants flood the country. No, he won't, because I can tell you what will happen. Albo will be out on his ass and it'll be Peter Dutton in.
Yeah.
Right? And they'll stop immigration. Or, what I'm saying is there are mechanisms that the property bubble won't go on forever. Right? Exactly. Like stock bubbles, they don't go on forever. Like Bitcoin, right? Like all of the bubbles, they don't go on forever. It's just a matter of when does it stop? I don't know. But all I can say to you is the yield is 1% and you stand a good chance of losing a lot of money.
Yeah. All right. Thursday, Biden's got COVID, so we probably won't spend much time on that.
No.
Friday, S&P total return. Given the S&P returns in the past 5 years were driven more by valuations than earnings, we shouldn't be surprised if the market reverses at some stage, which is what we've just been talking about for 25 minutes.
Yep.
But
just on that, what it's saying is people are speculating not based on real fundamentals. They're speculating based on, but it's going to be double.
Yeah.
So in other words, they're not looking at the valuation or the yield and going, man, I'm only, if I was forced to hold NVIDIA for 50 years, I'd get 0.8% every year, right? What people are doing is saying, but it's going to be worth, $500 next year, and investing on that basis.
Half the world's GDP by the next 5 years.
Exactly. Yeah.
It's just outrageous.
Yep.
In the bonus section, this is quite an interesting one. We've highlighted a few times now that geopolitics will now be trumping, pardon the pun, economics.
Yes.
Just with the amount of hostility toward countries at the minute, I think it's important to, maybe we'll make a bit of a mini series or do some more videos on the geopolitics side of things.
Yeah, we talked about it. This is the fundamental part of the new normal. And what, again, the benefit of being older is I was there in the 80s. I was young, mind you, there in the 80s when we transitioned from the regulated economy, from the government owning Qantas, from the government owning the Commonwealth Bank, from the government owning Telstra, from the government owning CSL. All of that stuff now is starting to come back. Right, because the geopolitics has changed, and that's why I'm being a little bit harsh on economists who are saying, it doesn't make any sense that we should do our own things, where we can get them from China. And it's like, guys, it's not about economics anymore. It's about politics and national security. And that's what they're not, what they're doing is failing to understand that it's not just all cost-benefit analysis. Right, there's much broader goals now, and they're growing inequality. All of that sort of stuff is now contributing, and economists can't deal with that because they're stuck in the free market theory. Yeah, but we can get it cheaper from China, and it's like, I know, but China's also threatening, countries, blah blah blah. So it's we're not going to support that regime.
Yeah.
Right, that's what's going on.
They're dying on the hill now that basically countries have agreements with China and all these Russia and things like that. So there's a 10-year agreement to supply X, Y, and Z. That can change with a signature.
Absolutely, absolutely, and they do.
Yeah.
They do. Listen to the talk at the moment. No one's talking free trade agreements, right? Yet we've got one with China.
Yeah.
Right? Now, the Chinese are now punishing Europe for putting tariffs on the EVs. So the China said, we're going to do a pork investigation. Now, this is late July, but the Chinese today were at the WTO saying they want to look at the Americans' Inflation Reduction Act for the subsidies, right? So what I'm saying is that's a response because the Americans said we're going to put tariffs on your steel and on your EVs, right? All we've got now is tit for tat, right? Now, you have to say, okay, what breaks that? I don't know what breaks it, but it sure as shit ain't Russia, war, China,
you have a
the
change
Middle
of
East.
government.
Absolutely. It's now we're on a new trajectory. And it plays to local politics now in China and in the US and in Russia to say foreigners are bad people, right? We can't trust the Americans anymore, right? And the Americans are saying the Chinese are hostile and the Russians are saying the Europeans, want to take over Russia. No one's going to wake up tomorrow and go, you know what, come on, guys, let's just get in a room and talk about it. It's over, right? Yeah. And that's why I say economics is not going to make any sense because we're not dealing with economics. We're dealing with politics. And politics by its very nature is about power, which is not about making sense. It's about power.
Getting one up, yeah.
Absolutely.
Yeah, all right. Well, the short story, Canada's finance minister said he'll hold talks next week with business and labour groups about electing trade barriers against Chinese-made vehicles, which is what we've just talked about, and suggested that the government may even go beyond autos as well. Yeah.
You're just going to see this creep up, mate.
Yeah.
I can tell you right now, this is just going to expand more and more until we get to the point where it's safe enough for everybody to say, well, we can cut them off in some way.
Yeah, that's why ourselves now.
Yeah, and that's why that's why I believe commodities will have a good 10 to 15 years because we're going to now scramble to lock in energy sources and raw materials.
Yeah.
Right? And so even though you might say, dude, there's heaps of iron ore all over the world, yeah, but I'm not allowed to get it out of Russia anymore. Right? Or, no, China's not allowed to buy it from Australia anymore. It's got to be America and other Asian nations. That changes the dynamic between supply and demand, right? Because what you're doing is saying we're not allowed to buy from them anymore, so therefore that supply is not available. So now you've got to adjust it by going, well, we only can get it from this country and it's more expensive. Yeah, but we can get it off China. It's really cheap. No, we're not allowed to buy from China anymore. Oh, right, okay.
Or you can, but there's a 90% markup on it because
that's exactly right.
So well,
it's even look. I can see this going on in China right now. The Chinese are basically tapping companies saying don't buy any American products. Right? You can see it in also with Japanese products. Right? The Chinese are simply saying just don't buy any more of those products.
Yeah.
Right? And
they have to because
they have to, right? They have to.
All right, we might end on the chart of the week, which is a quick one, but it's an oldie but a goodie. Most people go into investing and say, 99% psychology, and you just got to be positive and all this kind of stuff. I won't call it garbage, but because there are a few fundamental things with an investor psychology that allow you to have an edge, which is what we're saying is it is 99% about the process,
Absolutely.
99% about having an edge, having a strategy, understanding what you can do differently to the general population, because most people do lose in investing.
Yep.
And it's like being a card player. If you know how to read a deck almost, and you know what's come out, and you know what hand you need to play,
yes,
you can keep playing that hand, and even if you win 51% of the time, over the long term puts you ahead. So understanding a few key psychological factors about yourself and what your personality is like, and then building a process and a strategy, it is 99% about having that edge and having that strategy, which is it's just a pie chart of 1% psychological factors, 99% edge.
Yeah. It's just if you have an edge, most people will tell you is in the process. If you work out how markets work, you work out the mathematics works, then you can develop an edge. You can get out of bed every day with a growth mindset and it doesn't mean shit.
Yeah.
Right? Because just because you get out of bed and go, hey, I'm positive, I'm going to stay positive. I mean, you don't go into investing going, oh, man, I'm probably going to lose heaps of money, right? Everyone goes in with a, quote, growth mindset, right? And this is, again, a lot of this guru stuff of, you've got to have a growth mindset. You've got to be positive. You've got to be this. No, you've got to develop a bloody edge.
Yeah.
And that comes from serious study and understanding how it works, right? Not getting out of bed and going, I'm going to be the next Elon Musk. It's like, okay, best of luck, but, it's probably not going to happen.
Where the psychological factor comes in for me is because I'll talk about cryptocurrency because every day I'm trading that backwards and forwards, is getting up at 9 o'clock, looking at the charts or looking at what's happening and going, I don't want to fucking buy anything here.
Yes.
But I'm going to because my strategy says I need to. That's the psychological side of it.
That's the edge too, because if it falls, that's the best time to buy.
Yeah. Pardon the F-bomb for the end of it. All right, we might leave it there. Guys, if you want to have access to the week that was document what we read from every week, again, go to the website. It's literally called The Week That Was. It's free and you'll get it in your inbox every week. Also, our ETF beginners course is still free on the website, so head there and download that. And as always, follow the socials, Instagram, TikTok, Facebook, and give us some feedback. All right, thanks, Steve.
Cheers, mate. Bye. See you next week.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And, as always, remember, we don't provide financial advice.